Tiffany, you just look at the reaction across the board in all the markets. And do you think that this is definitive, that streak of hotter numbers that had everyone worried, is it starting to reverse? Are we going to be back in believing in a downward trajectory in inflation again? Because we got thrown for a loop since the beginning of the year.
Yeah, well, I certainly think that prints will be cooler than what they were in the first quarter of the year. But nevertheless, that might not mean that they are in line with the Fed's target. A 0.3 on the month over month, yes, it's down from last month. But it suggests an underlying pace of inflation, that's not at 2%. And when we look at the details, I think the core services ex shelter categories, I know you mentioned OER was still a little strong as well, but those categories have really been the ones that have been surprisingly strong lately. And underlying that tick down in the year over year rate, we have seen, 3 and 6 month moving averages of inflation start to accelerate higher. So to me, the big takeaway from this print is that, it takes hikes. If Powell said that rate hikes were a low probability and makes them even lower, but it doesn't necessarily mean the Fed's not going to delay. So we think they will delay rate hikes to get more rate cuts to get more confidence that inflation is truly coming down.
What do you think, LaVorgna? This a surprise to you?
No, we had 3 really strong numbers. 0.28 was the 2 decimal place change, and that's about 3.5% annualized. So we're still a far cry from anything close to 2%, unless, Joe, and the conspiracy theorist in me would never suggest this, but maybe the Fed ultimately changes its target, because I don't see how you get to 2%. And the equity market loves it, but with profit margins at an all-time record high, unless you got this great productivity surge, lower prices means lower margins, which means lower stock prices. So right now it looks great, but we'll see.
Wendy, what do you think? What do you make of the numbers?
Yeah, so the 3-month rate, at an annualized rate over the last 3 months, core CPI was at about 4%, and that's a fair bit lower than it was last month at 4.5%. So that's good news. But I think Powell's been pretty consistently clear that he needs to see a normalization in the factors that underlie inflation before he's going to feel really confident that he's got inflation under control. And once again, we saw the good news in core goods. So core goods over the last 3 months fell at about 0.5% at an annual rate, whereas core services were still pretty strong and quite strong relative to 2018, 2019. And so if Powell needs to see a normalization in the contribution to CPI inflation from core goods and core services, we're still a long way off from that.
At this point, I said that earlier, that they might not call it moving the goalposts, but there's different ways to move the goalposts, aren't there?
Question is, why is Powell so afraid? And the answer, Joe, I think, is the banks, the commercial banks. If you look at the portfolio losses and their mark-to-market, and hold-to-maturity portfolios for treasuries and mortgages.
Could break, yeah?
And they would know that. The market wouldn't know that, but the Fed would know that because they regulate these big banks. Because when Powell pivoted in December, there was nothing to suggest in the data at that point that really they're going to be cutting as much as the markets thought. So I think it might be something there. You're looking at like 25-30% of these losses as a share of banks' net income. That's the only thing I could think of for why he still wants to be so dovish.